Ladies and gentlemen, good day and welcome to Elecon Engineering Company Limited Q4 and FY24 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Tina Brahmani from Motilal Oswal Financial Services. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone. On behalf of Motilal Oswal Financial Services, I welcome you all to Q4 and FY24 earnings conference call of Elecon Engineering Company Limited. We are pleased to have with us the management team, which is represented by Mr. Prayasin Patel, Mr. Ayush Shah, Mr. M.M. Nanda, Mr. P.K. Bhasin, Mr. Kamlesh Shah, and Mr. Narasimhan Raghunathan. We will have an opening remark session from the management, followed by a question and answer session. Thank you, and over to you, Prayasin, sir.
Thank you, Tina. Good evening and a warm welcome to everyone on our Q4 and FY24 earnings conference call. On the earnings call today, I am joined with Ayush Shah, Non-Executive Director, Mr. Nanda, M.M. Nanda, the Head of Gear Division, Mr. P.K. Bhasin, the Head of MHE Division, Mr. Kamlesh Shah, our Group CFO, and Mr. Narasimhan Raghunathan, CFO. We have uploaded the press release and investor presentation on the stock exchanges and the company's website, and I hope everyone had the opportunity to go through the same. I will start with industry and business overview, and then I will hand over the call to Kamlesh, our Group CFO, to discuss the financial performance and the quarter and financial year ended March 2024. I'm delighted to announce that Elecon Engineering has achieved remarkable milestones in its financial performance for FY24. We have achieved our highest ever revenue amounting to rupees 1,937 crores and a profit after tax PAT of 356 crores in FY24. Now I'll talk a bit about the economic landscape. The global economy is showing signs of recovery with inflation declining more rapidly than the expected in most regions. However, persistent geopolitical tensions in West Asia and supply chain disruptions remain a potential risk. India in particular is poised for accelerated growth. The Indian economy is projected to expand at 7.5% in 2024. According to the World Bank, in October to December 2023 quarter, the economy exceeded all expectations, achieving a remarkable growth rate of 8.4%. This performance was bolstered by robust investment and strong performance in both the industrial and service sectors. Manufacturing PMI improved to 59.1 in March and up from 56.9 in February. This reflects stronger growth in new orders and a resurgence in job creation. These positive indicators signal an even better performance for India in the coming year. Let me speak about Elecon now. Elecon is one of the largest industrial gear solution providers in Asia. In the Indian market, we proudly hold a leadership position with approximately 39% market share in the organized sector. Our expertise lies in delivering end-to-end gear solutions, catering to a diverse range of industries, including cement, steel, power, sugar, among others. At Elecon, we offer the widest range of gears, ensuring seamless operations and efficiency for our clients. Whether it's gearboxes for heavy-duty applications or precision components for critical machinery, we are committed to excellence with our best-in-class products and capabilities. Our dedication to innovation drives us to continuously invest in research and development, ensuring that we adapt to the ever-evolving needs of our customers for productivity and customization. We view new product creation as a strategic imperative, ensuring that we remain at the forefront of the industry. Moreover, we are equally committed to safeguarding the health and longevity of these gearboxes, ensuring their reliability and performance. While we excel domestically, we are equally dedicated to expanding into the overseas market, which presents significant growth opportunities for Elecon in the years to come. Our global network spans across more than 85 countries, facilitating our mission to serve our clients worldwide. For the fiscal year ended March 2024, our contribution to the overall revenue from overseas market stood at 24%. Now I'll move to giving updates on our two segments, the Gear Division and the MHE Division. Our Gear Division contributes nearly 85% of the overall revenue as of financial year 24. We take immense pride in being industry leaders when it comes to lead times. Our streamlined processes and efficient workflows enable us to deliver with unmatched speed, making us a reliable equipment provider. What truly sets us apart is our focus on customization and precision. Whether it's tailoring gear solutions or specific requirements or ensuring impeccable engineering, we consistently raise the bar. Domestically, the government's strong emphasis on capital expenditure, coupled with an upswing in end-user consumer demand, has significantly bolstered our domestic performance. Looking ahead, we anticipate that our order book for the next year will align with the current trend. This confidence stems from our increased order inquiries and increased wallet share we have secured from our existing customers. Additionally, we have several products currently under development. The launch of these new offerings is poised to drive further improvement and reinforce our market position. Internationally, we believe exports is the way to go, and it brings me great satisfaction to share that we are making progress in this arena. We have successfully partnered with 11 OEMs in the overseas market. These collaborations span diverse industries, including plastic, rubber, steel, among others. The references and credibility we gain through these partnerships serve as a powerful catalyst for further expansion. Additionally, we actively participate in overseas expos, where we showcase our cutting-edge product capabilities. Beyond our product offerings, we recognize the importance of after-sales services in accelerating growth. By combining all these efforts, we are poised for sustained success in the overseas market. Moving to the MHE division. Within this division, we have strategically discontinued our EPC work. Our focus now lies entirely on product business and after-sales services. This year gone by has experienced a surge in order inflows, particularly from some of the most esteemed industry players. We firmly believe that government investment in infrastructure development and mining will act as powerful catalysts, propelling the growth trajectory of this division even further. Finally, at Elecon, our values and principles form the bedrock of our identity. We prioritize sustainable practices, envisioning a future that shines even brighter by wholeheartedly embracing diversity, ensuring safety, and actively uplifting our communities. Elecon fosters a social responsible ecosystem where everyone thrives. With this, I would like to hand over the call to Kamlesh Shah, our Group CFO, for financial highlights for Q4 and FY24. Over to you, Kamlesh.
Thank you, sir. Good evening, everyone, and a very warm welcome to our Q4 and FY24 earnings call. I will now take you through the highlights of our financial results for Q4 and FY24. Our consolidated revenue from operations for the quarter ended March 2024 stood at rupees 565 crores as compared to rupees 425 crores in the same quarter of last year, a growth of 33% on YOY basis. The domestic market accounted for 79% of the revenue and balance coming from the overseas market. EBITDA for Q4 FY24 stood at rupees 135 crores, growing 46% from Q4 FY23. The EBITDA margin for the quarter stood at 24%. The driving forces behind this performance were a strategically enhanced product mix, cost management measures, and targeted process improvement initiatives. PAT margin for Q4 FY24 stood at 18.4% as compared to 16% in Q4 FY23, registering an improvement of 240 basis points. For the year ended March 2024, consolidated revenue from operations stood at rupees 1,937 crores, registering a growth of 27% on year-on-year basis. As mentioned, Elecon has achieved the highest ever revenue in FY24, underscoring the company's resilience and strategic focus. EBITDA stood at rupees 474 crore, registering a growth of 40% as compared to FY23. The EBITDA margin for the period stood at 24.5%. The PAT for the period stood at rupees 356 crore, a growth of 50% on a year-on-year basis. Moving on to the segment-wise performance, Gear Division accounted for 80% of the revenue, while 20% was contributed by the MHE Division in Q4 FY24. In FY24, 85% of the revenue was contributed from Gear Division, while 15% was contributed by the MHE Division. Taking about the Gear segment, consolidated revenue from operations for the quarter ended March 2024 stood at rupees 454 crores as compared to rupees 366 crores, a growth of 23%. Revenue for the year ended March 2024 stood at rupees 1,644 crores, up by 25% on a YOY basis. The EBIT for the quarter stood at rupees 115 crore, a solid year-on-year growth of 47%. The EBIT margin for the Q4 FY24 stood at 25.5% as compared to 21.4%, reflecting an improvement of 410 basis points. EBIT for FY24 stood at rupees 420 crores as against rupees 288 crores in FY23, reflecting a growth of 46% YOY growth. The EBIT margin for the year ended March 2024 stood at 25.6%, registering a growth of 360 basis points. The order intake for FY24 stood at rupees 1,601 crore, up by 15% on YOY basis. Order in hand is rupees 536 crore as of March 31st, 2024. Moving on to the MHE Division, revenue for the quarter stood at rupees 112 crores as compared to rupees 58 crores in the corresponding quarter last year, growing 93% YOY. Revenue for the year ended March 2024 stood at rupees 293 crores, registering a growth of 35% on a YOY basis. EBIT for Q4 2024 stood at rupees 26 crores as compared to rupees 11 crores in Q4 FY23. The EBIT margin stood at 23.4% as against 19.2% in Q4 FY23, increasing 420 basis points on YOY basis. The EBIT margin for the year ended March 2024 stood at 23.3%, an improvement of 830 basis points on a year-on-year basis, primarily on account of better product mix. The order inflows during the year ended stood at rupees 393 crores as compared to rupees 223 crores in FY23, up by 76% on YOY basis. The open orders as on March 31st, 2024 stood at rupees 260 crores. Furthermore, our total consolidated order book, including both divisions, experienced order inflows of rupees 1,994 crores during FY24, and the total open orders as of 31st March 2024 stood at rupees 796 crores. Now highlighting a few developments during the quarter and year ended March 2024. As mentioned previously, we are pleased to announce that we have signed off one more OEM business agreement in quarter gone by. This brings our total overseas OEM business to 11, having annual estimated business volume of 6 million euro. This progress underscores our commitment to expanding partnership. We anticipate the commencement of commercial production in FY25. In our efforts to grow our share of business from overseas market, we are expanding our network. We continue to make progress in recovering funds through arbitration awards. As of March 31st, 2024, we have received rupees 37.2 crores out of the total awards of rupees 63 crores. Furthermore, we have initiated fresh arbitration proceedings with a total volume of rupees 31 crores during Q1 FY24, outcome of which may take 1 to 2 years. We are confident of positive outcome. We have proposed final dividend of rupees 2, that is 100% per equity share, and split of shares from rupees 2 per share to rupee 1 per share, both subject to the shareholders' approval. Lastly, our guidance. Our revenues for FY24 stood at rupees 1,937 crore, growth of 27% on YOY basis, with EBITDA at rupees 474 crore and EBITDA margin of 24.5%. While we initially projected an annual revenue guidance of rupees 2,000 crore for FY24, external factors have resulted in a minor deviations of 3%. It is essential for us to clarify that this deviation is primarily on account of decrease in the raw material prices, impacting our overall order value and hence revenue. If we compare on a like-to-like basis, assuming commodity prices remaining stable, we have delivered on our guided performance. In fact, overachieved. But on account of softening of raw material prices, we have to adjust our selling price accordingly. We are happy to report that we have outperformed on our margins guidance and have delivered 24.5% for FY24 as compared to our initial guidance of 22%. So if you look at the overall scenario, our guidance miss on revenue is 3%, but have overachieved by 250 basis points on margins, which have delivered higher absolute margins on our original guidance of 2,000 crore. Looking ahead, as we extend our guidance for FY25, let me share some perspective here. We are mindful of the challenges posed by geopolitical tensions in West Africa conflict, disruption in the supply chain, and the election period in India on account of this situation. We are confident of sustaining margins at the current level. On this note, I would like to open the floor for Q&A.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask the question. The first question is from the line of Rohit Natarajan from Aditya Birla Sun Life Insurance. Please go ahead.
Thank you for this opportunity. So my first question is to do with the FY25 guidance. The last call you said it will be revealed only after assessing the current.
Rohit, sorry to interrupt you, but we are losing your audio in between.
My first question is more to start of FY25.
Rohit, sorry to interrupt you once again, but we are losing your audio. May I request you to rejoin the queue, please?
Sure.
Thank you. Participants, please restrict to 2 questions per participant. The next question is from the line of Kashyap Zaveri from MK Investment Managers. Please go ahead.
Thank you so much, sir, and congratulations for a great set of numbers. My first question,
Thank you.
Obviously, hello.
Yeah, we can hear you.
Yeah. Okay. So first question is actually repetition of the previous participant, which is about the guidance for 2025. You spoke at length about, how export markets we are trying to achieve through tie-up with, some of these OEMs. So if you can throw some light on guidance for 25. Second is a bookkeeping question. If I look at your cash flow statement, again in 2H, we have had some inventory write-downs as well as some, provision for bad debts totaling to almost about 23-24 crores. If you adjust for that, in fact, your margins adjusted versus what you have reported go up by another about 200 basis points, right? So, one, why this is repeating yet, given that we have now shifted from, the EPC model to only product model in our MHA division, why is it repeating? And two, should then the margins for next year be even significantly higher than what we have reported for second half of this year, if you adjust for the bad debts? So these are the 2 questions that I have.
Yeah. If I answer your first question about the growth, revenue growth. So we have positioned ourselves this year as 15% growth compared to what we have achieved for FY 2024.
Okay.
Why we are conservative over here? Because there are a number of, the issues or challenges are there, which you might be aware to some extent. So one is the West Asia. There is this complete disruption which is there, where now it is getting escalated. So we also don't know where it will get ended up. Second, in India, that we are now presently going through an election period, where we have some code of conduct in due to this election, due to which the orders by the PSU will be on hold, and which will get released only, I think we believe that it will be only after August onward, it will start, flowing over there. Second, USA is also going for an election by November 2024 sometime, and that also, because the US election has a wider impact, considering the dollar being a centralized currency. So considering that also we are cautious. So to all these 3 factors, if and more particularly if that West Asia, the challenges, geopolitical challenges, if it gets calmed down or reaches to a normalcy, I think we have the scope available to do better in Q3 and Q4.
Yeah.
If I give about the write-off of the inventory, it is nothing but a conservative approach what we are having. Because what happened when we are having the CSC business, we have to keep some of the inventory with us, which we do not know when it is going to get utilized. So considering as a conservative approach, we say why we should not have the conservative approach and make a write-off for that inventory. As and when we use this inventory, automatically that will be converted into an additional profit for us. And so far as the bad debt is concerned, we have took this bad debt as a conservative. Again, I am saying we are going with a conservative approach, both for particularly for ECL provision. In ECL provision, considering the length of the recovery and in consensus with our auditors, we say yes, we would be okay to make an additional provision considering the lapse of time under which we are not able to recover, because most of them are under dispute and under legal arbitration process, which may further delay the recovery of the outstanding dues to the customer.
So then underlying margins are even stronger than what you have reported. Is that something that I take home from this?
Yeah, it is. It is because of the product mix. Our margins are better.
Okay.
Yes.
Just last one clarification. In terms of your capex this year, that number was roughly about 40 odd crores. Is that right number?
No. 40, because we have already spelled out in FY23 that our total capex plan is 300 crore INR.
Okay.
And we are on that track. And by the end of this year, we will complete this capex plan of rupees 300 crore, which will be in place.
And this will be both divisions, here as well
I
as
will, sorry, I will interrupt. 300 crores is for a period of 3 years. So it is 100 crores each, but we are looking at a total segment of 300 crores because, the delivery dates of machine tools nowadays is far longer than, 9 months or quite often more than a year. That is the reason why we have taken a period of 3 years.
Okay. I have more questions, but I'll come back in the line. Thank you so much, sir.
Thank you.
Thank you.
A request to all the participants, please restrict to 2 questions per participant and kindly join the queue for a follow-up question. Next question is from the line of Rohit Natarajan from Aditya Birla Sun Life. Please go ahead.
Yeah. Thank you. Thank you for this opportunity. I missed some remarks. I don't know if you have talked about the guidance for FY25. What will be that split between gears and MHE, and how much of the quantum will come through exports?
Yeah. So our guidance for FY 2025, at the consolidated revenue, we are estimated at rupees 2,225 crore, of which we are expected nearly 360 crore from MHE division and balance from gear division, of which we are expecting my revenue from overseas, for the overseas operation, that is export from India and the overseas operation by itself, we are estimated at nearly 250 crore.
Okay. I appreciate this remarks. My second question is more to do with the OEM, 11 OEMs, where you said that the prospective indication to begin with, it will be something like 6 million euros, and going forward it could be much bigger. Can you give us a big picture, as in once, let's assume this orders get accepted, and in a bullish or maybe base case scenario, what will be that quantum of revenue coming from these OEMs?
So if I give the answer that 10, 11 OEMs which we have garnered during the year FY 2024. So, and we are estimated that the annual business volume from these OEMs would be to the tune of euro 6 million. And we are expected that this year we are going to get the revenue from this OEM of nearly 3 million euros. That is what our estimates are there, considering how we are accelerating our delivery and completing the prototype supply and the testing of the same. We think that considering the current challenges in the European market, where the current existing player locally over there, they are facing a lot of challenge about the availability of the manpower, particularly mechanical engineers. Also, the other challenges of high inflation and otherwise, the supply chain got disrupted, because of which OEM, the existing OEMs, they are looking for the alternate solution. And that is where Elecon is getting and pitching in and getting the opportunity to garner the business from that.
Got it. Sir, help me then reconcile, how is this exports becoming 50-50, your long-term, maybe within the next 5 years as such, where the revenue targets will be coming to exports is what you have guided for. How do we bridge in that picture?
Yeah.
Okay. Can I, Kamlesh, I would like to add to the further on the 11 OEMs.
Please, sir.
Apart from this, you also need to understand that once we are successful with these OEMs, what will happen is it will open up the doors for their competitors also to come to us, or we are going to them and bagging additional orders from the competition. Okay? Because all their competitors, seeing that that Elecon is able to supply to the OEM at a cheaper and a competitive rate with good quality and performance, they will take this opportunity and also contact us for supplies to them. So this 11 OEMs may